Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, August 21st. We're recording this before market close. I'm David Zarling. I'm here with the man who greets all the virtual planes in the sky, Ian McMillan. We have an S&P 500 at 3390. This week we recorded a new high on a daily basis close for the S&P 500, but it wasn't the only one, and we have plenty to cover today. Ian, where would you like to start?
Yeah, good. So we got the intraday high, got an all-time closing high. If the market stayed here, I believe that's an all-time weekly closing high, same as last week.
Right.
I take that back. This would be the first all-time weekly closing high.
Right. With the last one being early February with a close at
Mid-February,
33.80.
yeah.
Last week when we were recording, we were getting close, but didn't get there.
This
So talk
week
to me,
we have it.
Talk to me about that. Like, let's say we've got our new daily closing high, all-time high in the S&P 500. We get let's say we get a new weekly. Now time will tell what closing price matters most, but we get a new weekly closing high. That's bearish, right? Like that's bad news.
Yes, some people take that mentally as stocks have gone up too far.
Right, and I think where do you think that?
I don't know. I think that just the phrase "all-time highs" it has such an odd
Well, and it doesn't. Don't you think
impact
it has to
on how people view the market?
Right, and don't you think it goes back to the old adage
Because
of buy low, sell high?
Exactly. And so when someone tells you, gosh, this is the highest stocks have ever been, wow, like I don't know how much longer I want to hold on.
Right. And so never mind the whole buy high, sell higher.
Especially this whole, what's in the context of 2020, I think that behavioral bias, if that's what you want to call it, I would call it that, is even more prevalent because if stocks are higher and unemployment's also 5 times as high as it was in January, right? That's a huge disconnect to, I'm going to say, not just a large percentage of market participants, but a majority of market participants.
Absolutely.
I think that there's a lot of people out there. I mean, literally tens of hundreds of billions of dollars under management that cannot grasp that type of market and economic divergence.
Right. And even though the market's not discounting today, the market is discounting 6 to 12 months in the future. It's the current sentiment about the prospects of an economy, prospects of businesses, prospects of society 6 to 12 months in the future.
I think you see that same mindset with all these people, and maybe this is a better conversation for the extended version, but all these people that get obsessed with, the market cap thing. And, recently a big one is now Tesla's bigger than Walmart, and people are flipping out over this. And I have no idea why it matters. Who cares?
Right. Well, and that goes back to our process,
I don't know.
right?
Maybe people are projecting that Tesla becomes the highest sell. I have no idea.
What if in 6 months Tesla has a vehicle that delivers the things from Walmart to your house?
Yeah, I
don't know. Like what?
But there's
what
this
does
whole
it matter?
idea that because a car company somehow can't be quote unquote worth more than, I guess you want to call it a large box retailer.
Well, and some of it has to do with growth, but that goes back.
A lot of it has to do with growth,
but it has to do with process, right? Like, so part of it going back to the all-time high thing, that old adage of buy low, sell high. So if something's high, well, we don't want to buy there. But they should be thinking about, well, most processes can succeed with a buy high, sell higher, because that's the definition of a trend, right? The most bullish thing something can do, a stock or a bond or whatever it can do, is keep going up. That's the most bullish characteristic you can have, is have new highs.
When you have 126 years of data, and you go and you throw the Dow Jones and the Dow Jones Industrial Average on a chart, I don't understand why people don't get, if stocks go up over the long term, that how making new highs isn't. How do you think that they're in an uptrend over 126 years? They had to have keep making new highs.
Correct. For stocks or bonds or anything to move higher, at some point it has to make new highs, and it has to keep doing that.
Yeah.
Right.
And
like GE,
people
right?
are flabbergasted that, what if, and you go back to, what was the last big breakout? I'd say 2013. That was when we got above the 2009 highs and the 2000 highs.
Yeah,
so
2013.
A generational breakout.
Yeah, 2013,
and
it was a 13-year
you had the
sideways
same
base.
people back then saying, gosh, stocks are back to where they were in 2000 and 2008. Like, they're clearly overvalued. I don't think I really want to own them anymore. And
overvalued is such a loaded term too, right? Because what are we using for that metric? Are we saying PE, like PE ratio?
I think I think it's the idea of the last two times we were here, we had a big bear market. And I don't know if you want to call that recency bias. Unfortunately, we have recency bias over bear markets. We always like to compare, whatever we're going through to the last bear market. And bear markets only happen every, I don't know, on average once a decade, maybe.
Well, we've had 2 in 2 years, so.
We have had, but.
No, I hear what you're saying. That's a little abnormal.
Average,
that's yes.
It is
average.
abnormal. I mean.
Well, let's be clear that that's not a fair statement to say abnormal, because there's nothing quote unquote normal about markets. It goes back to market uncertainty is certain. That's the same characteristic. And so, but what you're saying is, because of those two most recent bear markets, those 20% plus drawdowns in the past 2 years, recency bias looks at that, plus hearing all-time highs, and it's immediately, well, oh my goodness, that can't be right.
And those are the last two, right? Big draw. I mean, no one wants to talk about what happened after 1982. No one wants to talk about what happened after 1987. Those are too far in the past. So we get stuck on that, and now it's going to be for sure February. That's the most recent. Everyone's comparing that, oh my gosh, we're higher than we were in February, and I don't know, fill in the blank ratio.
Well, and I'll when we hear people talk about it's overvalued, they usually try to use some type of metric like PE, like price to earnings ratio. You hear it all the time.
Yeah.
PE, the PE. I challenge listeners to go out and look at what was the PE of stocks in March 2009, and you tell me whether those were overvalued.
Yeah.
And I think they're going to be very interested to see what they found was for PE back at that point in time. And so for using PE as some type of signal of when you can or cannot participate in stocks is a little bit naive. So new all-time highs, I know we've harped on it. I know the Wilshire 5000 recorded a new
Wilshire 5, exactly.
And so
obviously,
that's
as we say,
go ahead. It's a wider breadth.
NASDAQ's been there.
Right. It continues to make new highs. It's the bullish. Right. When did the Qs do that?
It made back in, it had to have been 2 months ago.
Right. Basically back in June. It made a new all-time high, and has continued to make new all-time highs. And again, I'm not saying that everything just shoots to the moon and that's how this goes. We can have some summertime weakness. We can have stocks pull back here. In fact, I would say my impression, again, this is an impression, so it's not actionable, that if we have some type of correction move in here, I'm just saying some type of pullback, 5 to 7%, everybody and their mom's going to be thinking it's another huge correction.
Yeah.
and they're going to be loading up on shorts, and that's going to be fuel for the next move higher. But we'll cross that bridge when we get there. Maybe we don't have that little pullback, but we're open to all possibilities. I don't want to make it sound
Or they
like,
just keep eating up supply.
right. They keep chewing through supply.
Which
and
they've been, I mean, this week has kind of been, obviously there's been some, we gapped up on Monday, of course. And as we seem to do every Monday.
No, that's a great point that you just said, because that's a market characteristic, right? Like this gapping up on Monday thing, that's been something that's been going on for a while, right? Or am I
mean, you've had
or am I off base? Am I off base in saying that?
1, 2, 3, 4. The last 4 Mondays have been gap ups. Am I reading that chart correctly?
Yeah, I think so. And so, it's one of those things market characteristic wise, like.
And before that, we had 2.
It's something, and we've talked about in the past how from the bottom, a lot of the percentage move has actually happened in the overnight session. And so you've had a lot of gaps with not a lot of potential in the middle of the day. But that's, you get the market that you get. We don't always get the market that we want. But regardless, we've got Wilshire 5000, we've got NASDAQ, we've got S&P 500, new all-time highs. When we look across different areas of the market, we haven't touched base necessarily on international stocks for a while. Anything we're noticing, whether it's across the pond or in different markets regarding that?
I'd say overall still pretty lame in regards to outperformance.
Right, as far as like just looking at right.
Participation, I mean, it's good. Like European financials have held up. European banks, it's always kind of a good canary in the coal mine. The Nikkei, again, kind of flirting around 23,000. The DAX continues to hold up above 12,300. That's kind of has been our line in the sand. It's really just been consolidated. DAX hasn't gone anywhere since June 4th.
Nikkei's up against the important level, like you said, at 23,000.
I mean, small caps haven't gone anywhere since June 8th.
Right.
Now we could be seeing a retest today, but.
Yeah. And European financials participating since the bottom, it's important. At the same time, they're at the same price they were back in July 2016 and back in 2011 and 2012. So European financial stocks haven't done anything for a long time. And so that goes back to what's in your portfolio. Should you have some of these areas?
I would say I'm surprised the strength in materials hasn't spilled over to some of these foreign areas, particularly like Latin America. Usually they kind of
go hand in hand,
especially when it comes to the base metals.
Yep, metals. And copper, an economically sensitive area, has had quite the week as far as.
I mean, copper's just now it's
it gave back some today,
but yeah,
it touched the $3 level.
To $2.98. So we'll see if they are.
But we haven't seen, basically your point being, while we've seen some areas like base metals, which typically has a relationship or a correlation with, emerging markets, we're not necessarily seeing this major shift to international just quite yet. When you look at a long-term, we haven't been in an uptrend in something like emerging markets versus the S&P since back in 2010. So we continue to see lower highs and lower lows in that relationship going back that far, but we keep an eye on it in case that rate of trend changes, and that's something we can take advantage of. A lot of other noise that we continue to hear, we kind of touch base on bubbles. People like to use that term bubble. And my only caveat would be bubbles can last a long time. If we're calling them bubbles, were the late 90s.
Well, and bubbles are always compared to the last bubble, right? So again, kind of going back to the PE ratio, a lot of people want to compare what's going on now to 2000. So
right. And
I don't know. I think that it's clearly not a practical way to manage assets, because you can't sit there and not participate and say, well, we're just nervous that things have got too extended.
Right.
Because we could be saying that since,
Who knows?
I don't know. I mean,
Who knows? And the whole, like, so there's a sentiment out there, you know, with the election coming up. We've heard the word bubbles tossed around. We've heard, you know, we're due for a correction, which I don't know. I go back to the 20% plus drawdowns, right? We had the one in 2018, end of 2018, that was 20%. We had the one back in February, March, that was 35%. So due for a correction. So we're going to do another one, and that's fine. I mean, we're open to anything.
I mean, we literally just shut down the world. Stocks fell 35% in a month, and people, I don't know. Do people enjoy bear? Are there some people that enjoy bear markets?
No, I just think,
seem to be, I mean, these people just absolutely desire them almost.
Well, and that, you know, I think that has to do with going into like the FinTwit community. I know our clients don't enjoy bear markets.
No, but I'm saying
unless they're being, you know, protected from them. And I think it goes back to just people being on the edge of their seat, right? Like, we're due for a correction. It's a bubble. There's an election, right? The last few, you know, the beginning of this whole 2020, right? Like, how many times you hear someone say, "Oh, that's so 2020." Right? Like something negative happens and they're like, "Oh, that's so 2020." That's kind of the mentality that's kind of spread across society, is this, it's so 2020, meaning obviously we've had the COVID and the ramifications that came from it. We've got the election coming up. We've got protests. And so people are just on the edge of their seat. And it's one of those reasons that we use price, right? Because price is going to dictate. It's what allowed us to scale back into the market. It allowed us to protect client accounts back in February and March. Price is price. Who are we? We're not smarter than the market. No one listening to this podcast is smarter than the market. I hate to say it, but that's the truth. And the market knows more than all of us. And so while we hear these things like bubble, election, and due for a correction, those are things, Ian, that you've talked about in the past. They're like climbing the wall of worry. Markets like to do that.
They absolutely do. I think with all of the bearish and negative overtones and the woe is me attitudes and, you know, this sky is falling. And yet when you look under the surface, for example, you've got FAANG stocks, mega cap growth, tech, all these super important areas making new relative highs, not just new absolute highs, but they're leading the indices.
And when Ian says FAANG stocks, he means like Facebook, Apple, Amazon, Netflix, and Google, these core tech type companies, growth companies that when you put them in a basket and you compare them versus what do they look like they're doing versus the S&P 500, they continue to outperform. We continue to see that. We continue to see tech lead. And that's not a, you know, when the largest sector in the United States continues to lead, that's not a bearish characteristic.
It's not. And it can mask so much weakness. You know, people ask me, well, you know, what happens if small caps start to outperform? That's great.
Yes, that'd be awesome.
As if that's some type of negative thing.
That'd be great.
That would be awesome.
Yes, it would be awesome.
I would love for these mega cap stocks to be able to take a break.
Right. And it would be perfectly normal if they did, if they consolidated. And but they also, I mean, you could argue they also kind of did just consolidate for a month.
They did. I think, you know, we're kind of still waiting on Microsoft to break out. But for the most part, I mean, Amazon's just this week coming out of a month-long consolidation. Apple continues to just be Apple. Google, I think, is pretty close to breaking. In fact, today it should, and again, another, you know, going back to, this is a 6-week consolidation in Google. It's not, I think maybe Facebook also. So I believe Facebook broke out of a consolidation. No, it's kind of been I guess it did a couple weeks ago. But
well, these are offensive stocks. These are the all-stars of the market.
and the other offensive stocks, I know FAANG gets a lot of airtime because the media likes cute acronyms. And these are the best stocks, but it's the other things like the Teslas and
software coming back,
software. You've got Chinese tech. I think Alibaba is getting ready to break out of its respective
cloud computing.
That's 6 weeks of consolidation. Essentially the Amazon or eBay of China. Almost looks exactly like the Amazon chart from 3 days ago. So a lot of good things happening. Solar continues to act well. Retail in general.
Right, retail in general.
Equal weight and cap weighted.
And we're not sitting here going, well, look at all these defensive sectors that are leading, right? Like everything we just talked about there, finishing with a green week, we've got things like utilities, staples, and I know we can have an argument about what healthcare is, but we'll just say it. If we want to throw in the defensive category for today, it can be offensive a different day. But those are all
real estate,
all finishing red.
And real estate, utilities, both going out at new relative lows. Discretionary versus staples continues to make new highs. Just some super important things. And what people forget is even in 2003, 2000 to 2007, 2008, it was, there's always a small cluster of stocks that are pushing the market higher. It used to be Bank of America and Exxon and Chevron and JP Morgan. And now it's Apple and Amazon and Google. And next cycle, it'll be another handful of stocks. Who knows what industry they come from? It could be transports. It could be
a new industry.
Go back to banks. Exactly. It could be,
Who knows?
Name it. No one knows.
No one knows because internet's the
Maybe
90s.
Cryptos become their own sector.
Right.
And then we go through a 4-year crypto where we're just, Bitcoin's at 50,000 and it's whatever happens. I have no idea.
No one does. No one has their crystal ball and
telecom services have been strong again with Google and Facebook helping, but obviously clients familiar with kind of those 3 main areas: tech, discretionary communication services.
Well, and you brought up cryptos. I know, some of our clients in one of our models are familiar with a little bit exposure to Bitcoin there.
A little bit exposure. Mark Yesko, if you listen to our podcast.
Just got off zero, baby.
I just got off zero. I hope you're proud of me.
But how about we do it? How about we do it rather than him telling us, which we didn't, and we just do it based on relative strength.
Well, he told us to do it back in January.
Yeah, but we can do it based off of relative strength. Do it quantifiably rather than just on one man's barstool opinion. So that's a nice new development. One of the things that's maybe gaining a little bit of steam among some of these larger companies are some stock splits that we've seen.
Yeah. And again, this is something that absolutely, the fundamental crowd just pulls their hair out over it as these stocks trade higher, right? Because it doesn't change it does nothing,
right?
Except for it has nothing to do with the value of a company, but you've seen it in Apple, you've seen it in Tesla. Just these things get scooped up.
Right. And
as soon as they mention a stock split, I guess Tesla's going to do a 5-for-1. Is that correct?
Well, yeah. And let's just walk through that for someone who might be, a little unfamiliar with the process. So let's just do a 2-for-1 rather than a 5-for-1. If you've got a 2-for-1 stock split, right, you're going to receive an additional share, except the same price. So let's say we got $100 stock. You own 1 share. In a stock split, 2-for-1 stock split, you're going to have 2 shares that are worth 50.
Mm-hmm.
That's the basic essence of a stock split. And so, like you said, Tesla's doing a stock split. Apple's doing a stock split. These are major companies that are doing stock splits. We haven't seen a lot of stock splits in recent time. They've been there for sure. But that's more something that was happening during the roaring 90s is there were a lot of stock splits happening. And here we are. And doesn't that fit the theme again that we've been talking about, where we've got?
I mean, what if Amazon splits 10 for 1?
Great. Do it.
Can you imagine the emotional reaction to that? 10 for 1, I guess that brings it back. I mean, what if they did 30? What if they brought Amazon down to $100 a share?
Again, it just makes the price per share lower. It doesn't change the overall cap.
And I think we touched on this last week. I think in probably the next 2 years, stock splits and this emotional reaction to, oh my gosh, I can get things cheaper, probably won't matter as fractional shares become more. Yep. And people will say, well, who cares? I bought $5 worth of Apple, the other day. So we'll see. Obviously, Elon will get his 420 secured. I think that's what Tesla, people say it could end up splitting around that price. I guess that has to stay at 1980 or something. I don't know. Right. I can't do math that fast in my head.
Right. So completely understood. So it's an interesting potential new development. Now, again, two companies don't make the whole segue to a new narrative, but it's just something that we've noticed that could be more prevalent as share prices rise among these bigger stocks.
This is something I want to get into the extended version. Do you think Tesla was the most emotional short squeeze of the last 10 years?
Okay, let's save that for the extended version.
Emotional short squeeze.
Yeah, and if you want to know what a short squeeze is, if you've never heard that term before and you want to stay on, absolutely do that. Before we get there, Ian, anything you want to cover before we jump to that extended version?
No. Continue to like markets. I continue to ride the trend until it comes to an end. I don't know. We could we could gap down on Monday. We could continue rallying. I have no idea, but we are going to stay on the right side of the trend as we have been for the last 5 months. And we will let the markets tell us when to roll over. Again, some lines in the sand. You guys kind of know where we stand at 32.25, 32.50, which was that February 24th gap down.
Yeah, even
that's where I'd start to be a little bit alarmed. But until then, from a historical behaviors perspective, we're going to close this week most likely at all-time highs. I don't know what's wrong with that.
Yeah, there's nothing wrong with it. It's not bearish because the most bullish thing a market can do is make a new all-time high. Like Ian said, if we're closing below 33.30, 32.25, we'll have things to manage risk with there at those levels, and we'll act accordingly. Clients know that. They know that we're not afraid to make adjustments based on that information. And so, Ian, thanks for another great week, and thanks for all of you guys for listening and for the great feedback. We'll do it again next week. Otherwise, stay on for the extended version.
Have a great weekend, everyone.
All right, Ian, heading on to this more in the weeds section of the podcast. I know you asked about Tesla being the most hated or shorted stock in history. Was that basically your question?
Yeah, I mean, I've just from what we've seen, right? So Tesla, talk of the town for the last, at least the last 2 months, just absolutely ripping higher. Now, as technicians, I am not super surprised once we broke above that 380, 385. It consolidated for 6 years.
And then it came back and tested it and then went higher. Yeah.
And so the absolute just, I won't get into specifics. Dave and I were at a conference last April?
Yeah. Yeah.
And one of the keynote presentations was on why Tesla
the keynote
why Tesla is such a fraud. And what was interesting is we're at a technical analysis conference. The presentation touches very little on technicals.
Very,
It's mainly
very
about,
fundamental.
the typical stuff we see. Elon stupid.
Tesla
cars
cars starting on fire. Yeah, the pump up. Remember the pump up video?
He pisses off the SEC too much. I mean, the amount of things that have been said to try and prove why Elon is a bad CEO or right? And that goes back to, he's just a crappy CEO. He's not a good leader. He doesn't care about his employees, all this stuff. And I'm sorry. I mean, you get the break above 380. Then we retest 380 back to the March lows. Tesla did bottom early on the 18th, along with, again, something we've touched on. The strongest stocks that you see today did not bottom on March 23rd, then bottomed on March 18th. That is held true to, that was something big we picked up on in April. And that's a conversation for another day. But I mean, just the absolute pain and misery that Tesla has caused investors, obviously not if you're long, but I think it's the biggest. I can't speak to the actual short float, and I don't remember what it was at different periods in time, and I'm not going to look up what it is now. But I'm talking about a behavioral short squeeze.
Right. And so I'm going to play devil's advocate is not probably the right phrase to use here, but I'm going to play both sides of the road, which isn't fair from a standpoint of like, you might be looking for just like one answer, but like going back to, that conference and that like it even had the pump up video where it's like getting people, like it was just it was a big like display of like bravado on how terrible this company was. Now, in fairness, that company Tesla did break down below, like 255, and that range in Tesla going back to 2017 was a 30% range, and that breakdown from 250 took it all the way down to almost 180, 185, and that's a
180
30%.
was the big support that
right. And so you did have a breakdown. You had a 30% range. You had a breakdown that equated measuring that target of 30%. So you had a 30% drop. To your point, from that point forward, once we got back above 255, the squeeze was on. I mean, it was like, because everybody piled in on that short.
Well, and if you take a measured move, right? So it had this huge move 2012 through 2014-ish, mid 2014.
Right.
Consolidated 4 or 5 years. I mean, so you've got a 1,200% return measured move coming out of this consolidation. I'm going to start that at 180, which takes us to roughly 2,200. I mean, it's just not totally unfathomable that it's done this from a technician's perspective.
Well, especially if you get if you get so many people short the stock, and when you have so many people that are short, as soon as that price moves against you and you unwind that short position, you have to buy to make that happen.
Well, and how about the people that don't even hate it? They didn't hate it because for all the other extraneous reasons that we've mentioned, and there are literally Twitter accounts dedicated. I mean, there's a whole community, thousands of people on Twitter dedicated to shorting Tesla, and the Tesla Q community is a very loud. Well, they haven't been too loud.
Well, so is the other side. I mean, there's also a diehard group too.
But I think there's a lot of people that even jumped in that weren't Tesla haters from the beginning. But when it got to, $1,000 or $1,100, $1,200, that were like, okay, this has gone too far. We can't keep doing this.
Price is price.
Then the true fundamental crowd, so not people that short stocks because they think Elon's stupid, but people that say, oh my gosh, look at this. Again, use XYZ ratio that we've mentioned, PE, price to book, blah, blah, blah. They start looking at car production numbers. I mean, there was even a time when people were sending drones over Tesla factories to try and see how many cars were in the parking lot so they could try and guesstimate on, there's so much. You're right. There's so much infatuation on both sides.
Yeah, it's pretty strong. I don't have a flag to plant in either direction. I think Teslas are a cool car. I've been in one. I think they're great. I think the stock, if it's moving up, is great. I don't have a problem. All I'm saying is that range in 2017 through the beginning of 2019 was a 30% range. You could have been short, back April at the start of that conference, hit the measured move, 30% down, and then the squeeze was on. And to answer your question, have you ever seen a squeeze like this? And I don't want to compare companies and make it seem like these are comparable. They're really not, because they're different. I mean, stocks are stocks, so that's the same. But I remember when Facebook IPO'd, and
oh gosh, yeah,
it took a big
IPO
dump
of the last decade.
I mean, it even got a magazine cover with a thumbs down.
The thumbs down.
That is worth
the
$15
Barron's cover with the thumbs down.
Yeah,
and then from that down to $7.
Yeah,
15,
like lots
$17, right?
Yeah, a lot of people were short that, and that's ripped higher, obviously. I think back to early 2000s when the internet bubble did burst, and the tide moved out, and it was reflected in stock price. You saw lots of companies get dragged down with an entire sector, whether you want to call it the internet sector or the tech sector. You had a company like Amazon get pulled down during that period of time. And it's not like everything was clear that Amazon was a successor. And that's why you go back to price, right? Because in the end, price is the final arbiter of value, not PE ratio. We don't get paid in PE ratio. We don't get paid in opinions. You get paid in price. And so in the end, Amazon making a series of higher highs and higher lows, making new all-time highs after new all-time highs, is the hallmark of a stock doing well. And that's what Amazon's done since that point. So to answer your question, I actually don't think I've seen a short squeeze quite like I've seen from Tesla. I'm sure if I had, if we took some time and looked through a bunch of charts, we'd be able to find something, but it's pretty epic.
It is almost, and it kind of goes back to a question you raised earlier this week. Are Teslas made of lumber?
Are Teslas made of lumber? And the reason why I'm chuckling is because all lumber has continued to
moving lumber is it's gapped up another 3. I mean, it's insane at this point. And it's kind of had this long-term, I would say, resistance around, you want to go back to the late 80s. I'd say around 490 for whatever. I mean, we got a little bit above there in, mid 2018. But I think it goes back to the residential housing theme. Yeah, well, lumber is clearly in high demand right now. It's gone from $250.
I was going to say the last 2 months it's doubled, basically. I mean, you've gone from 430 to almost 830 in 2 months.
And it's like what do they call that? Like random length lumber?
Yeah, and random length lumber, and it's an impressive move, and the reason why Ian is asking that question is because Tesla has an impressive move on its hand, and so obviously correlation is causation. We think Teslas are made out of lumber because obviously, look at what lumber is doing. That's insane. But I will
or is lumber made out of Teslas?
Yeah, maybe they found a way to install Tesla lithium batteries in lumber. I don't know, but I do know that higher lumber prices typically are coincident or
look at 26. A huge rally 2016 to 2018, 2014, 2015 kind of down. So definitely, lumber bottomed in March 2009 with everything else.
You know what? I actually would it be interesting, and I might have to do this over the weekend because that's that's the way I live. I might have a drink and I might go look at lumber futures from back in the early '90s. And the reason why I say that is because if you think about like echo boomers, it's just an interesting, obviously a lot of houses are used with lumber. It's just a demographic thing, when I think about boomers and when they built their houses and now echo boomers when they're building their houses. It's just interesting to see if you saw a same type of move. All I know is that demand is outpacing supply and lumber is ripping. And the same is happening with Tesla. And the fact that it's happening with lumber and what we've seen in gold and silver recently, they're consolidating now, but that's definitely coincident with or involved with inflation. That's an inflationary characteristic for sure.
So the last time lumber had this type of move was probably late 1992.
Do you know that? Do you have a chart?
I do have a chart. So I don't know what happened after 1992.
Early 90s. Okay.
Yeah, I don't,
Interesting. Okay.
I'll leave that for the
let's just leave that one there.
And
everybody could just sit on that one for
you got to do your own research.
You do on your own research.
Ponder that over a scotch this weekend.
Yeah. Do it. Yeah.
I sure will be.
Exactly. So a little bit of inflation. We kind of touched base on gold and silver. They both had, last week to move, if you will, but they had broken out of bases. You had gold at all-time highs. Again, not a bearish characteristic, but also one of those things where, with consolidation, you don't have to be involved with every single price tick. You can wait and see what's going on.
Yeah. Right, gold and silver had a nice rally. Gold's still above 1900. I'm going to err on the side of the team and all-star charts. I think I agree kind of with what their sentiments have been, that long-term bullish as long as we're above 1900. Short-term, we'll see.
Yeah, short-term, because, everything has to digest. And so very nice move from gold to get to all-time highs. Again, that's not a bearish characteristic. And if you were to consolidate, move sideways above all-time highs, how potentially bullish is that?
Sure.
And then basically what we look for consolidations when price moves sideways is confirmation or rejection of the trend. And so if you're breaking upwards out of consolidation, that's confirming. If you're breaking down, that's something different. And so that's, you just wait and see how those things develop. Kind of going back to stocks a little bit, we had the fastest bear market ever, basically 1 month, February into March. We've had a 5-month recovery. That's one of the fastest on records. Just comparison wise, 1987 also had something like a 35% drawdown like we had in February, March. That took 20 months to get back to where it was when it started. It took 5 months in this case. What I find interesting from a behavioral or psychological aspect of this is just conversations I have with individuals, right? Because we get to have lots of conversations. Mm-hmm. This isn't a negative. This is just something I notice is I might get a text that says, hey, just opened up my account. Wow, that's great that, this scenario is played out and here's where my account balance is at, because they did not look at their account when the correction happened. Right. So that's loss aversion because they were so afraid to look at their account during the correction that then it's almost like they forgot the correction even happened. So they have market amnesia. It's a really interesting side-by-side deal where
and it feeds I think unfortunately, and this will come to roost at some point, is that it definitely even feeds more the buy the dip mentality.
Oh, right. Buy the dip mentality, buy and hold works, right? Buy and hold works if you hold on forever and you never sell and the market always comes back. Those are two key characteristics of buy and hold.
And it's timed nicely with your retirement plan.
Right. Yes, and it's got to be timed nicely for when you retire. That, 0.3. Very good.
So if you retired in 1972.
Yeah.
Yeah,
go ahead.
You drew down on an account that went sideways for a decade.
Or retired in 2000 and the market went sideways for 13 years. Or you're a Japanese retiree and your market's gone nowhere for how long? 20, 30 years. So these are real behavioral aspects where we're noticing that some individuals refuse to look at their account during a correction because they were afraid of pain. So loss aversion, open up their account at a different point in time, notice that it's not as bad just because the market did come back. Nothing said the market had to come back. And then it causes market amnesia as if the event didn't happen, right? So then that leads back into the all-time high things. If you have loss aversion, didn't look at your account, so you basically have market amnesia because you don't remember the correction, but now you're at all-time highs, that seems, well, how can that be? And so people then have fear. It's a really interesting psychological dynamic between loss aversion and market amnesia. I just wanted to highlight it. It's just something I've been noticing. We don't have to spend too much time on it. But I know.
Well, how quickly were people texting in April, be like, what should I be buying?
Right. Yep. And that's the buy the dip mentality. And that's the retail involvement, right? That's the, quote unquote, if we're in a bubble and we have this dispersion taking place and we've got a certain leadership group leading and everything else is lagging and it's narrow and it's fast and it's high and volatility is high. I mean, that fits all the scenarios of a fifth wave. It fits all the scenarios of retail being involved, buying the dip. It's a really interesting
Is
time.
the fifth wave, I'm not an Elliott wave. Is the fifth wave supposed to be the strongest?
No,
or is the third?
typically the third.
Third's the strongest?
Third, but fifth has everybody involved. Fifth is going to have retail and institutions involved. Everything is good. Everything is glamorous.
Well, gosh, then I
think we're just at the start of that. Don't get me. I'm not saying.
I don't think enough people have thrown in the towel. Again, I think that there's so much of a better insight into individual market participant behavior than we had back in the 90s, right? I mean, I was in the 1990s, I wasn't getting like hateful DMs on Twitter, people telling me like how wrong I was about stocks. But
I was just getting them in the mail. I'm just kidding. But your point is valid. Like, I think what you're saying is like, this doesn't mean we're close to the end.
No, I mean, if again, you talk about whatever it is, I know some people hate this term, cash on the sidelines. If you don't like, then call it whatever you want to call it. But there is some truth. Again, I'm not trying to step outside this, our TA bubble that we choose to live in. But if there is, as someone like Tom Lee would like to say, trillions of dollars still on the sidelines and portfolios out there, at some point those people have to throw in the towel.
Right. Well, yeah, cash on the sidelines, and it's one of those things where let's just check off some of the market, because we are technicians, so we can look at the weight of evidence. So what are the pieces of evidence we have before us right now? So yes, we had the fastest correction, one of the fastest recoveries. We have retail involved. We have heightened volatility. We have dispersion. Okay, so we've got a scenario where there's certain leadership groups that continue to lead, and there's certain laggards that continue to lag. So you have this widespread. That is not an unusual characteristic for something like the late 90s, where you had certain areas of the market that were pulling the rest of the market with it, kicking and screaming. And like you look at something like the S&P 500 compared to the NASDAQ and then compared to the Dow looked like absolute crap during the late 90s. But yet you had stocks.
Horrible. So it's small caps.
Right, exactly. But yet you had leadership out of tech. You had there's so many similarities to now. And I'm not saying the outcome for the 90s has to be the same now.
Like no one looks back and says, oh, you remember the 90s, like when small caps sucked? No,
right.
No one prefaces or no one memorializes on the 1990s except for what was going higher.
Right. And what I mean by this dispersion thing is, for example, since the quote unquote beginning of the panic correction in February 19th, you have energy stocks, let's use XLE, still down, not down at the bottom, like still down today,
about 60%. You have tech stocks like the NASDAQ 100 up 20%. So you have this massive spread between the best performing sector and the worst performing sector. You have something like, I know Andrew Thrasher put a chart out there that was just saying, hey, when the S&P 500 makes a new high and we have less than 50% of stocks in S&P 500 with a rising 50 DMA, if you were just to look at the past 10 years, that's not a great deal, but that it was a common thing in the late 90s because you had this dispersion. You had tech leading, you had large cap leading, you just had this differentiation. And that's a really important part of asset management, is identifying what are the laggards, what are the relative weak stocks, and what are the relatively strong stocks. Don't own garbage.
Don't own this stuff.
Right. Don't own garbage. And so, you know, like you said, there are periods of time where small caps underperform. Now they might participate, like technically be in an uptrend. They're just not the same uptrend as these other areas. It's not everything moving at the same pace higher, you know, because I mean, technically energy is still higher than it was back in March from the panic bottom, but it's nowhere near, like, even like something like equal weight S&P 500 is 8% away from its highs. And we have cap weighted S&P making new highs. So you have this dispersion characteristic, and it's not uncommon to have this situation. And so I think we're going to continue to hear, you know, weeping and gnashing of teeth as you have this dispersion happening and you're quote unquote diversified, because that means you're also owning the laggards.
And they're going to whine all the way up about banks aren't outperform, you know, banks aren't participating, banks are doing this, small caps are doing this. Oh, look at the breadth measures. Look at, you know, the percent volume up, down days. It's going to get, I think, from a data, right? Because how much time do we talk being in this era of data mining? There's always going to be something where one of your check boxes probably doesn't get, you know, there's always going to be some type of, I wouldn't say worrisome, but, you know.
No, there's always going to be.
You can have 2 red flags, but if you have 8 green flags, then.
Right. Exactly.
And weight of the evidence.
It's weight of the evidence, and there's different market environments. Yes, there are markets where volatility is low, everything's moving in unison, and the pace is the same. There's other market environments, and it makes sense, where volatility is high and you have dispersion. And there's market environments where institutions only involved and retail is on the sideline. And there's market environments where they're all together, and you have to be open to outcomes. And so that's why we use price. You know, as long as we're above 33, 90 on the S&P 500, that's a quality characteristic. If we're below that, we could be churning sideways, chewing through supply like you talked about. If we're below 33.30, below 32.25, that's a different story. We can be open to a corrective move. No one's sitting here on this podcast saying, oh, all we see is we're just going higher, higher, higher. We don't know. So I got a little bit on my soapbox there. And before we get out of here, I got to touch on 2 baseball things here. Is that all right if I switch to that a little bit?
You absolutely can.
Have you seen what Zach Greinke's been doing?
Zach Greinke's a stud, dude.
I love that guy. So
just literally, no pun intended, but he's just throwing it in opponents' faces right now.
And so I don't know why no one has not thought of this before, but
why don't if they're so upset over what Fernando Tatis does, why aren't people getting
exactly if Fernando Tatis can take a 3-0 cookie for a grand slam, and that's somehow an unwritten rule, because I grew up playing baseball that every pitch you battled, it didn't care if it was 3-0. Now I get it. If his coach told him to take and he didn't take and he hits a grand salami, that's a conversation that happens in the locker room. It doesn't happen in front of the press. But throw a better pitch then, if you don't want it to be a grand slam. But yeah, to your point,
I don't get that.
Why isn't Zach Greinke then getting in trouble?
Out here mocking batters.
Well, yeah, he's up there giving the 2 sign. He's going to throw the curveball. Did you see the most recent thing he did?
And then he does throw the curveball and gets him, because he's so in your head at that point.
Right. Think about how brilliant
If a
that
pitcher
is.
told you what they were going to threw it, and struck you out, I'm probably going back to the clubhouse for the rest of the game.
Or he tells you what he's going to throw, does it 3 pitches in a row, and then the other time he doesn't. I mean, it's such a brilliant psychological mess that he's created in your head. And then did you see the recent one where
I haven't.
he throws a pitch? It's a great pitch. It's low in the zone. It's a curveball, some type of slider curveball. I'm not actually sure what it was. Something with movement that was out of the zone. The batter lays off, and he basically yells out, "Hey, way to lay off," or something like that to the hitter. So he like congratulates the hitter for laying off one of his great pitches.
This is
I'm
what
like-
we need. And do you think? I mean, maybe Zach has always been like that, and now the fact that we can hear everything in the stadium.
Yeah, maybe he's been doing that.
Maybe the guy's just been messing with batters his entire career. Certainly has come more to light this year. I personally think it's hilarious. I also think I don't know why we're, Fernando Tatis is trying to get paid, right? We make money based on our performance. I think that's how most jobs go,
Right.
in the world. It's kind of capitalism. And if someone's got a contract coming up or wants to be able to say when his contract does come up, look what I did, you're going to tell him to lay out. Plus, 3-0 pitches are a great pitch to hit.
Well, and
they're coming right down the middle.
Yeah, and I hate the argument that they were up by so much. What? Okay, go
Who
talk
cares?
to the Atlanta Falcons then.
Go talk to the Braves the night. How many evenings ago? Braves are up 8-1, ended up losing 17-14.
Perfect example. Like they're up 8-1, so now you're supposed to lay off 3-0 pitches with guys on? No,
Oh.
Their unwritten rules are unwritten for a reason because they're dumb. Like it's
They're
because
dumb and
someone
would
tried
ever
to
have the balls to say that in front of another professional.
Right. Because the reason why is because if you actually wrote it down and read it, you'd be like, "Ooh, that's bad. I gotta erase that."
That sounds stupid. Now that I say it out loud.
Yeah, you can't have you don't. Yeah, I can't do that. So we're up against.
Very
our
thankful
time.
baseball's back.
Yeah.
So NBA Bucks
up.
bounced back.
Yep.
Bucks bounced back last night. That was a good win.
It was a good win. Like to see them pull it out, but we are up against our time limit. I hate for cutting us off like this, but I want to respect everybody's time. Thank you again, Ian, for your time and your insights. Thanks everyone for listening, and we'll do it again next week.
Have a great weekend, everyone.